This is Nightly Business Report with Tyler Matheson and Susie Guerra. Brought to you in part by
TheStreet.com, featuring Stephanie Link, who shares her investment strategies, stock picks, and market insights with Action Alerts Plus, the multi-million-dollar portfolio she manages with Jim Cramer. You can learn more at TheStreet.com/NBR.
Music to Apple's ears. Apple is reportedly in talks to make its largest acquisition ever in the music business. But why does the company that created iTunes and the iPod need this deal?
Love on the rocks. Publicis and Omnicom call off their $35 billion merger. Is it a sign that other cross-border deals may also run into trouble?
And bargain hunting. With the Dow closing at a record, our market monitor has a list of cheap stocks that he says could soar 50% in the next year or so. We have all that and more tonight on Nightly Business Report for Friday, May 9th.
Good evening, everyone, and welcome. What a finish to the week. The Dow Jones Industrial Average closes in record territory. More on that in a moment. But first, it looks like Apple may sing a new tune. The company reportedly close to a deal to buy the headphone maker Beats Electronic, founded by rapper Dr. Dre and the record producer Jimmy Iovine. Price tag more than $3 billion. Apple investors not taking a shine to the news, sending Apple shares nearly 0.5% lower today. And that reaction is raising questions about what Apple's really after in this acquisition. Is it the high-end headphones, or with digital downloads on iTunes flattening out a bit, maybe it's Beats' new music streaming service, or is Apple just trying to reassert its cool factor by joining forces with a hip-hop mogul and a record producer? Morgan Brennan takes a closer look at Beats and what the folks at Apple may really be after.
Dr. Dre may be most famous for his music, but it's his Beats by Dre headphones that could make him hip-hop's richest man. That's because tech giant Apple could buy Beats Electronics for as much as $3.2 billion. If the deal goes through, it would be the most Apple has ever paid to acquire a company. So what is Beats? The company makes high-end headphones that already retail at Apple stores for hundreds of dollars. In January, it launched a music streaming service that competes with Apple's own iTunes Radio. But analysts say the products may not be the valuable part of this deal. Instead, it may be more about the talent, namely Dr. Dre's co-founder, Jimmy Iovine, the chairman of Universal Music Group's record labels and one of the industry's earliest adopters of new media platforms. He's reportedly in talks to join Apple's team in a creative role.
If you look at it at face value, it's just a bad idea. If you take it a step further and think about what it adds to their management team, it starts to make sense, albeit a very expensive acqui-hire.
This deal would represent a departure for Apple, which typically builds its own hardware internally rather than acquire it. Not to mention the fact that iTunes Radio itself only launched last fall. Talent or not, that's got analysts skeptical. But Beats did pull in a reported $1.2 billion in revenue last year. And its brand isn't just recognizable among consumers, it's even considered cool.
I think it's pretty dope.
Oh, I think it's very exciting news. Apple's a great company, and I think the combination of the two will be awesome for both companies.
I just hope that doesn't mean prices go up.
I think that means prices go up.
If Apple had them, it'll still be in the same position. I'll still be broke. So, yeah, I'll be trying to save up for them.
But a deal isn't done yet. Sources say an official announcement could come as soon as next week. But negotiations could also still fall through. For Nightly Business Report, I'm Morgan Brennan in Santa Monica, California.
Scott Kessler sees plenty of harmony between Apple and Beats. He's equity analyst at S&P Capital IQ. Scott, you know, this subject all day was getting debate on both sides. Either you love the deal or you hate the deal, and you just heard Gene Munster in Morgan's package saying it's a bad idea. Now, why do you love this deal?
Yeah, so I don't know if I love the prospects of the deal, Susie, but I do see a number of potential positives. Most obviously is that Apple is already in the very businesses that Beats Music is focused on, or at least Beats Electronics is focused on, as well as Beats Music. So first of all, you have the accessories business. It generated about $1.3 billion in revenue for Apple in the March quarter, and obviously that's Beats' bread and butter, right? They make headphones and earphones and speakers, and Apple sells a lot of those. So obviously removing the kind of middleman from that process makes those products more profitable for Apple. But I think more importantly on the product side, is the Beats streaming service that you referenced. It's newly launched, but I think it's something that Apple has been taking a close look at. I think they're very interested in trying to kind of better pursue and successfully execute on a non-download digital music strategy. iTunes Radio, we think, has garnered mixed reviews.
All right, be honest now. Would Steve Jobs do this deal?
I tend to doubt it, Tyler. I think this is the type of deal where right now, over the last year or two, it seems like Apple really has lost its kind of cachet from a brand perspective and even from a product perspective. And that's one of the reasons we think they're considering such a transaction. When you think about Beats and you think about what Apple has been doing over the last year, they hired the CEO, the former CEO of Yves Saint Laurent. They hired the CEO, the former CEO of Burberry. And they now have looked for someone to promote buzz marketing to basically get the company better aligned with, let's say, a luxury clientele as well as a greater level of visibility across celebrities. That's something that's important to them, and I think Beats helps them do that potentially.
Susie and I are available for a lot less than $3 billion.
All right, you should get in touch with them.
Happily to sign up. So, Scott, a lot of people have been watching Apple stock, wondering what's going to be the next big thing to move the stock. It crossed over $600 earlier this week, and everybody was so excited it's pulled back a little bit. There's a developers conference coming up next month. Is anything going to come out of that, whether it's an iPhone or some new product that could give this amp up the stock?
Right. So the way that we think about the next couple of months for Apple are initially, we completely acknowledge that the Worldwide Developers Conference that you referenced is coming. It's only weeks away, really, at this point. But that's really more a gathering focused on software and services. And so you could see new operating systems announced. You could see new features to various Apple offerings announced, like apps, for example, and new enhancements. But we don't see new actual hardware products being announced at this confab. However, we do expect within the next couple of months that Apple might make 3 key announcements. One is going to be a new iPhone. We expect it to have a bigger screen. People are looking for that. Number 2 is, frankly, new iPads. We think that people are looking for a refresh of that product line. And then perhaps most importantly, we look for Apple to announce its entree into the wearables category, perhaps with something that most of us would think of as an iWatch, so to speak.
Okay, we're all waiting for all those products. Scott, thanks so much for coming on the program.
Thanks very much. Take care.
Have a good weekend. Scott Kessler of S&P Capital IQ. Tyler?
Stocks wrapped up an up and down week with all the major averages seeing modest gains today, but that was enough, modest though it was, to push the Dow to a fresh all-time closing high. The Nasdaq and the S&P 500 finished the week just a little bit lower. Let's take a look now at how the markets settled today. The Dow gained 32 points, closing record high of 16,583. Nasdaq up 20 on a rebound in momentum stocks, and the S&P added a modest 2 points.
Allergan shares were lower on reports that it might reject a $46 billion takeover offer from Valeant Pharmaceuticals. The maker of Botox could reportedly turn down the offer as soon as Monday. If that's the case, it would be a big blow to Valeant and Bill Ackman. He's the activist investor who teamed up with the drug maker for the takeover attempt.
A lot of talk today on Wall Street about a cross-border mega merger in the advertising world that was just called off, just as the fate of 2 other big international deals hang in the balance. The business world may be flatter, but rising political sensitivities may be keeping some deals from getting done. Mary Thompson has the story.
When New York-based Omnicom and Francis Publicis announced their merger of equals last July, they expected their size and scales would help them better compete with Google and Facebook in the fast-growing world of digital advertising. 9 months later, Omnicom CEO John Wren said old world problems took down the deal.
If I had to summarize in a tweet, it would be corporate culture, complexity, and time. And I would still have 100 characters left.
Publicis CEO Maurice Levy had a different take, laying the blame firmly at Omnicom's feet.
One of the principles was that there will be equality in the management team. This has not been the case in the proposal of Omnicom, and I was going back and forth to try to convince them that we should have equality and it was impossible to get that equality.
Complicated from the start, the deal would have created the world's largest ad agency, with co-CEOs in New York and Paris. It was to be headquartered in the Netherlands, and its tax residency would have been in the more favorable UK. Wren blamed a politically charged tax environment in Britain as another reason the deal fell apart, though M&A attorney Frank Aquila downplays politics as a problem.
Every deal has political challenges. Even if you do domestic deals, there are regulatory issues, sometimes political issues, but those really are not the factors, by and large, that determine whether or not deals get done.
Still, two other cross-border bids are fanning the political fires these days. Pfizer's $100 billion offer for British rival AstraZeneca, raising fears about a corporate exodus from the U.S. This after Pfizer cited one of the deal's advantages as being the billions of dollars in tax savings it would reap with a headquarters in the UK rather than the U.S. Though any debate about whether this deal gets done revolves around whether Pfizer will raise its lowball price. Meanwhile, GE's $17 billion bid for the power assets of France's Alstom unleashed an emotional outpouring, with people concerned about a French industrial treasure being bought by a U.S. conglomerate. An outcry CEO Jeff Immelt doesn't see scuttling GE's bid.
We've done a lot of deals in Europe over time, and we're pretty experienced in this kind of stuff, so I think we got a good offer, and I think it'll be executed.
Politics may make great theater, but in business, price and power drive the final outcome. For now. For Nightly Business Report, I'm Mary Thompson.
We have another wrinkle about that Pfizer's proposed acquisition of rival drug maker AstraZeneca. It turns out the number of people who could lose their jobs if the merger goes through. The governors of Delaware and Maryland want Pfizer's chairman to come clean on how the deal would impact workers in their states. AstraZeneca has more than 2,000 employees in Delaware. Pfizer has more than 3,000 in Maryland.
Still ahead, small cap stocks are closing in on correction territory. Is it a warning sign to investors that a broader pullback is near? The Labor Department says the number of job openings ticked slightly lower in March to just over 4 million, but the share of workers who left their jobs rose, presumably for a better one. Analysts say that is a sign of strength in the job market.
Ralph Lauren posted an earnings beat, but the retailer offered a disappointing outlook, and that's where we begin tonight's market focus. The company said it expects global revenues to rise between 6% and 8% in the next year, but it warned operating margins would decline as it spends money to build up its network of stores, and that overshadowed an otherwise good earnings report. Shares fell about 2% to $148.81. Shares of Hilton Worldwide were up after the hotel operator announced earnings and revenue that both topped estimates. First quarter profit almost tripled, thanks in part to higher rates. Hilton also raised its full year forecast as it expects a pickup in business and leisure travel. That pushed the stock up almost 2% to $23.07. And Bloomin' Brands says quarterly profits fell 15%. Traffic decreased at its Outback Steakhouse restaurant chain. Like so many companies this earnings season, it blamed it on the harsh winter weather. Also, a shift in holiday timing negatively affected the quarter. Shares fell 2.5% to $20.89.
Vivus is facing a generic threat from drug maker Actavis. The company plans to market a generic version of Vivus's obesity drug. In response, Vivus says it will move to enforce intellectual property rights. Shares of Vivus tumbled almost 3% to $5.22. Actavis's stock also down slightly to $196.18. Radio Shack scaling back its plan to shutter as many as 1,100 stores because it was unable to reach an agreement with its lenders. Its current loan covenants require lenders to sign off on more than 200 store closings a year. Shares plunged 9.5% to settle at, get this, $1.33. Netflix is raising its internet video prices by $1 a month for new customers and giving current subscribers a 2-year break from any price hike. The company already announced it would up its rates last month, but we didn't know by how much until today. Now we do. Shares rose more than 2% to $328.55.
On a day when big cap stocks in the Dow closed at a record high, smaller cap stocks in the Russell 2000 index have gotten hammered lately. And as Dominic Chu explains, this is a trend that's worrying many Wall Streeters.
Some investors are pointing to a small sign that could have a big impact on the stock market in the coming months. They're looking at small cap stocks. Small cap stocks are loosely defined as ones that have a market value of around a little over $1 billion on average. The Russell 2000 index tracks these types of companies. It's had a rough go over the last couple of months. Since hitting record highs, it's now fallen close to 10% in value, what many traders call a market correction. Small cap stocks are important because they're viewed as a possible leading indicator for where the rest of the stock market is headed. The big concern is that the drop in small cap stocks could lead to a drop in other parts of the market. Take a look at the chart of the Russell 2000 versus the large cap S&P 500. Historically, they trade pretty much in tandem. But now they're not, and some experts blame it on economic worries.
The divergence between the Russell 2000 and the S&P is because the market's now saying the Fed's done easing and that the economy's got to carry the ball. And in that environment, there's less margin for error. So small caps are going to have a little bit more of a struggle until the economy shows strong signs of growth.
Among some of the hardest hit stocks in the smaller cap world are well-known names, like luxury auction house Sotheby's, which has lost a quarter of its value just in 2014 alone. Then there's snowmobile maker Arctic Cat, which has lost about a third of its value in that time. And teen apparel retailer Aeropostale, which has been cut in half. The latest market declines may have created an opportunity. And there isn't as much fear that the sell-off will have ripple effects elsewhere in the market.
I'm encouraged by the fact that this hasn't spread to the broader market, doesn't look like it will, principally because, we don't have the fundamental catalyst to do that.
The tug of war between the bulls and the bears continues. And for now, the bulls seem to be winning the overall battle. But small caps remain a key part of the market to keep a very watchful eye on. For Nightly Business Report, I'm Dominic Chu.
Our market monitor tonight says it's hard to find value in the stock market right now, but he's still finding some gems. He's Patrick Kaiser, portfolio manager at Brandywine Global. Patrick, welcome. Good to have you with us. You just heard Dominic's report. He says, pointed out that a lot of the smaller stocks have rolled over. Do you think they represent the better values or the big guys?
No, I think the large cap stocks, which my team at Brandywine works on the most, I think the large cap stocks are still the best place to find value in the market. A lot of the small cap stocks have gone from kind of tremendously overvalued to just slightly overvalued, perhaps. So we still think that many of the bigger, higher quality companies offer the most attractive returns going forward.
You have a couple of stocks you want to give as examples, and it seems like the running theme is that you're really looking for the bargains. And at the top of your list is Toyota, and you say that this is one of the cheapest stocks in the world. Make your case.
Yeah, absolutely. So Toyota today is about $108, $109. One of the interesting things, it has $40 of cash, net cash on the balance sheet. So you're really only paying $68 or $69 for the actual business. Earnings for the last 12 months are $11.50, $12, depending on how you treat some of the charges. So you're really paying 5.5, 6 times on earnings. So a very, very low PE relative to a market PE that's more than twice that. It's the #1 auto company in the world, tremendous balance sheet, very conservative management. As we look forward with the cash there, in a year or so, we think they're going to start buying back stocks. We think you can make 50% or more easily in this if you're a long-term investor over 2 or 3 years.
You've got a $70 a share price target on Citi. How soon could it get there? And this is a stock that, to me, feels like a very, very risky choice.
Yeah, well, so it's obviously a stock that's been in the headlines, but a lot of times the best opportunities for an investor are the things that nobody likes or things that thinks that people aren't going to work. So with Citigroup, obviously it's been in the headlines for the Mexican fraud, for failing the stress test, but we think they can earn $7 in a couple of years. We think that at $46, $47 a share, you're paying less than 7 times future earnings power. The other thing is, you think about risk, Citigroup is the only major bank trading below tangible book value, so tremendously cheap relative to other banks and, again, to the market.
Let's talk a little bit about MetLife. This is a stock at $51 that's pretty much trading today at where it was in January, so it's been kind of flat for the year. What's your target on this stock, and why should investors put some fresh money into MET?
Yeah, again, so the 3 I mentioned today, we all think they have maybe 50% upside over the next 12 to 18 months perhaps. Met, again, much cheaper than the market. Again, some controversy around it. It's got a lot of excess capital, a lot of extra funds. It hasn't been buying back stock because it's waiting to see what rules the Federal Reserve puts out there for insurers. But in the meantime, it's trading right around book value again, so we think not a lot of downside. It's trading at less than 10 times earnings, PE of less than 10. Again, very cheap relative to the market. We think that once there's some certainty out of Washington, that they will begin buying back stock, and it will be a tremendous opportunity for investors. So all three of these stocks, again, very cheap, some controversy, but that's really where I think value investors and investors that have a longer time frame in general can find the opportunities.
You want to exploit those headlines, don't you, Patrick?
We absolutely do. That's one of the things we do here at Brandywine, is to try and move against the grain, but stay high quality and in names that people know.
Takes some steely nerves to do that. I know you're a sort of a bottoms-up stock picker, or I sense that, but you must have some view on economic growth and interest rates. Would you share it with us?
Right. Yeah, absolutely. I mean, when you're buying big companies, the single biggest determinant of their results is the economy. So we absolutely do have macroeconomic views, and those drive how much conviction we have in our research. So when we look at the economy and we look at the interest rates, especially for the two financials, we think long-term interest rates, particularly long-term interest rates, rise. That's very good for Citi and MetLife. But more importantly, we think the economy is going to grow at a moderate pace. There's been a lot of debate over the last few months. Was it a winter slowdown? Is right now just a temporary bounce? But right before I came on the air, I saw that the Federal Reserve loan data, it appears that commercial and industrial loans are still accelerating. Commercial real estate loans are still accelerating. We believe the economy is gaining momentum. And so while we've had this debate in the market where we've been a choppy period, sideways overall, we do think that resolves itself. We don't think this is one of those years where it's sell in May and go away. We think this is a year where, as people become convinced that the economy really is doing well and picking up speed, that the market will have a much better second half of the year.
Patrick, do you have any disclosures on those three stocks, Toyota, Citi, and Met?
Yeah, you know, we, as a firm, we own shares in all of them because I invest in Brandywine's products. I own shares personally on all of them, but Brandywine does not have any banking relationships.
All right, Patrick, thank you so much for being with us. Patrick Kaiser with Brandywine Global.
And coming up, role reversal. At home, more women will become the breadwinners. At work, more will take over the corner office. Ahead of Mother's Day, a look at how this trend could shape the economy for years to come. That's next.
U.S. Postal Service delivering more bad news last quarter. Despite severe cost cutting, the agency still lost nearly $2 billion as the volume of first-class mail continued to tumble. And the federal government was unable to offer any financial help.
A new interim CEO for the Los Angeles Clippers. It's Dick Parsons, the former chairman of Citigroup and Time Warner, who's now a senior advisor at Providence Equity Partners. He'll be in charge of day-to-day operations of the team. This comes as the NBA is trying to force longtime owner Donald Sterling to sell the team after he was banned from any involvement with the league for making racist comments.
And here's a surprise job recommendation in a new memoir coming out next week. Former Treasury Secretary Timothy Geithner admits that he considered stepping down from the job in 2010 after the financial crisis, and he suggested that Hillary Clinton succeed him based on her experience as Secretary of State. Geithner writes that President Obama nixed the suggestion, and Geithner remained at the Treasury for another 3 years.
And finally tonight, with Mother's Day this Sunday, it's a good time to take a closer look at the status of women in the workplace. Steve Leisman has the story.
What seems unstoppable now is that the leaders of tomorrow are going to be women more than men, and the question is how companies will respond, and the country, especially when it comes to the controversial issue of maternity leave. More men over 50 have college degrees, but under the age of 35, the figures reverse. 40% of younger women have graduated college, compared with just 32% of men. This means employers, when looking for qualified talent, they're going to be choosing from a larger pool of educated women, more so than men. White House economist Betsy Stevenson argues making business a better place for women is going to be essential for business.
Female MBA students today say that when they go and interview with employers, the employers that talk to them about how they'll balance their job with their families are the ones they're most attracted to. So women are already telling us that they are choosing employers who are willing to make these changes.
According to the National Partnership for Women and Families, the U.S. is one of only 8 out of 181 countries in the world with no mandated paid paternity leave. The National Partnership is an advocacy group for such a law. The U.S. Family and Medical Leave Act, passed in 1994, mandates 12 weeks of unpaid maternity leave, but it only covers about 59% of workers that have access to the law. Now, Google is among the companies offering generous maternity leave. When they changed their maternity leave for women in 2007, they cut their attrition rate in half, so it can be cost effective. They extended some paid maternity leave benefits to men this year. There are obviously opponents to a national maternity law. Some argue the marketplace will make these changes even better than the government will. Given the growing trends of educated women, that seems almost certain. But some CEOs say a national maternity leave law would be preferable and cheaper to administer than 50 separate ones, and it could make good economic sense. For Nightly Business Report, I'm Steve Leisman.
I could talk for hours with you about that story.
I bet you could.
I think it comes down to pay and power. Are we going to see more women CEOs in the next decade? And also, they've got to figure out this work balance stuff.
No, definitely the case. I think women are the not-so-secret weapon of the U.S. economy. We are more engaged and have more women engaged in the economy than many other countries. And I think that is our... Happy Mother's Day, by the way.
Thank you. I'm so
glad
Have a great
you
weekend.
You bet I do. You kidding me?
That's Nightly Business Report for tonight. I'm Susie Garrett. Thanks for watching. Happy Mother's Day to all of our mothers watching this show.
And from me as well, I'm Tyler Matheson. Have a great weekend and a happy Mother's Day. We'll see you Monday. Did I say happy Mother's Day?
Yes. I'm Susie Garrett with the Nightly Business Report News Brief. Apple is close to finalizing its biggest acquisition ever, buying the maker of Beats headphones and a popular music streaming service for more than $3 billion. On Wall Street today, the Dow ended the week at a new record high. The blue chip index added 32 points, closing at 16,583. The Nasdaq was up 20 on a rebound in momentum stocks, and the S&P added 2 points. Two advertising titans scrapped their $35 billion merger. Reportedly, U.S.-based Omnicom and France's Publicis couldn't agree on issues of power and position. And a new interim CEO for the Los Angeles Clippers. Dick Parsons, the former chairman of Citigroup and Time Warner, will now be in charge of day-to-day operations of the team. Be sure to tune into Nightly Business Report right here on your public television station.